Good afternoon to all of you, and welcome to today's LNG panel. So I guess we'll start off by quickly introducing the panelists. First off, we have Skule of Awilco, Oystein Kalleklev of Flex, Alastair Maxwell of GasLog, Stuart Buchanan of Golar, and Richard Tyrrell from Höegh. So just as a very quick backdrop to what's going on in the market, I think it's fair to say that it's been consensus for some years now that the market is going to be short 20 to 30 vessels by the end of this decade. And I guess we've all been disappointed on multiple occasions when the market hasn't improved, but now things are finally happening. So now we're hearing rates well in excess of $100,000 a day, and it's certainly very exciting times ahead, given that we're only in September. So first I want to start with you, Jon, and maybe you can just take us quickly through the different dynamics that has caused the rates to rally and why the market suddenly got so good.
Well, it's not that difficult. It's supply demand, but of course I think for LNG it's more supply. It's more demand than anything else. We're in 2018 we have the biggest delivery from the yards ever in history, and still we're at $100,000 a day. The LNG volumes are of course growing like we know and we expected, and you know, this year we've had a good stretch with a lot of new LNG plants up and running. Next year is going to be much higher, much more LNG volumes on the water, fewer ships, and with the amount of LNG coming out of the US and demand, as we all know, based in basically or predominantly from Asia, it's good ton miles. So I don't think it's necessarily any more difficult than that.
But it could seem like the market is getting a bit greedy. We're hearing rumors of owners refusing $100,000 a day. What kind of factors are you looking for that is going to kick in and kind of push rates even higher in the short-term picture? Well,
if $100,000 a day is greed, you know, we were fixing at $5,000 a day a year ago or a year and a half ago. I don't think $100,000 a day is greedy at all. You know, we're, as you said, we're in September, market's $100,000 a day. If it doesn't make sense to pay that rate, well, then the charters won't. They're still making money, and we intend to only take our fair share of that going forward. And if you look at the forward curve on LNG going into the winter, there's certainly room for improvement.
Oystein, do you have any comments on?
No, I totally agree with Jon, and I'm very happy that other ship owners are thinking the same way as we are. You know, $100,000 a day is not that attractive these days. You know, LNG prices are high in Asia, and of course people are making money moving the LNG to those markets, paying a higher price, and it's time that the ship owners are taking a part of the value here, because people haven't been made money for a couple of years now. And then, of course, you know, we will bid for this. We have positioned ourselves for this. We have 4 vessels on the water, and we have 4 under delivery. We have, you know, deliberately not taken on long-term charters because we don't find the economics of doing that very appealing. So rather than doing that, we are taking a bet on the market, and we have a very good track record in the system of doing this kind of bet on the market. And our communication to the shareholders is that, you know, 2018 is the transition year. You have had poor market 14, 15, 16, 17 because excess optimism after Fukushima and then delays of Australian trains, and now the market is tightening, and it's actually a very short recovery cycle for a shipping segment. You know, you have a recovery cycle here without having to go through a scrapping cycle. And the reason for this is, of course, that you have long fundamental growth. You know, the market is growing 10% every year. The market is going to double from 2010 to 2020 in terms of liquefaction capacity. And then we are very bullish about the market. We said people don't buy the stock because of 2018 earnings, because it's going to be volatile, and utilization will be affected by this volatility. But, you know, we're very bullish now going into 2019, and we think rates, you know, this is the early phase of the recovery cycle for LNG, and we positioned ourselves for that.
Thank you. And last year we saw the Chinese demand had a large impact going into the winter, and at times 50% of their volumes were spot volumes. Alastair or Stuart, do you have any comments on what you think will happen with the Chinese increased demand going into the winter?
I think there's no doubt that Chinese demand is continuing to grow. If you look at year to date, it's approximately 40% up over 2017, and obviously 2017 was a much higher base than previous years. And the demand growth in China has been, to a very large extent, policy-driven and is now secular and structural. You know, once you convert a boiler in a home or an industrial facility from burning coal or burning fuel oil to burning gas, then you don't go back to those other fuels. And I was talking to someone in Beijing the other day who was saying that the impact on air quality in the major cities, particularly up in the northeast of China and particularly up in the winter, has been really, really noticeable. So the only signs that we see in China are that the policy of addressing both energy demand growth and also the need for greater air quality by burning more gas, that's going to continue. But I think the other major message that we always reiterate to people is, yes, China has been important to demand growth over the course of the last 18 months or so, and it will continue to be important as we look forwards. The reality is that demand growth has been much more broad-based than just China. And Southeast Asia, even Europe, if you look at Wood Mackenzie numbers going out to 2025, Europe is about 30% of the demand growth. Southeast Asia is about another 30%, China is 20%. And obviously Southeast Asia and Europe encompass multiple countries. But I think the real message here is this is not only about China. Demand growth is strong in other parts of the world as well.
Yeah, just to add to that, I mean, the latest figures that I saw this morning is that year to August, Chinese demand is up around 51%, which is even better. And some of that is because of restocking after a very hot summer that drew reserves right down. Some of it is to be a little bit more prepared than they were this time last year for the winter season, so they are stocking up ahead of that. They recognise that they'll probably run up against the same problems this year in terms of lack of terminal capacity, so they've indicated that some of those northern cities that they tried to switch from coal to gas last winter will stay on coal this winter. But no, Chinese demand is absolutely here to stay, and I think we've seen that sentiment in terms of their reaction to the US tariffs. Reducing the tariffs on US LNG from 25% to 10% tells you everything you need to know about their attitude towards keeping their air clean in China and their dependence on US LNG. But absolutely, all the headlines have been about China becoming the second biggest market for LNG, and people forget that South Korea last year, which up until then was the second largest market, itself grew by 10% or 11%. Taiwan, another big market, grew by a similar percentage. India, developing import capacity that in 4 to 5 years' time will be around 56 million tonnes per annum. That's more than total Chinese demand annualised to date will be this year. So, the focus needs to be on those other markets as well.
Thank you. You had a head start on my next question there, which is clearly the trade tensions between the US and China. And I think just for us sitting in the market every day, it's easy to do the calculations and look at what the market is, but for someone on the outside, it might be a bit more difficult. So I don't know if any of you have any view on how the tariffs could potentially impact LNG short term, but also long terms with potential, long-term FIDs in the US.
Of course, short term is not going to affect a lot. People is going to swap around cargoes. So if you have your Australian volumes going to Japan, you divert it to China. If you have US volumes going to China, you divert that rather to Japan. But of course, the big problem is the FIDs. So, people will be a bit reluctant to do FIDs when you have this uncertainty and nothing's going to happen with the trade talks before the midterms. So, what will happen here is, the Chinese will be running to Qatar, which they just did recently, signing up 3.4 million tons there for the next 22 years. They're going to run to Mozambique. They already have good connection in that part of the world. And they're going to run to the Russians. So the American volumes have to find a more diverse set of customers. Of course, the obvious candidates for the US volumes would be offtakes to the Chinese. But, there are, as the other guys have mentioned, there are other parts where you have a huge growth in LNG. So it's more that, that you're stalling some of the FID windows. That's the main challenge.
And I think the only thing I'd add to that is I don't know how long this is going to take to play out. I agree that we're not going to get much signs of resolution ahead of the midterm elections. But I am absolutely convinced that energy is going to be part of the solution to the trade relationship between China and the US, and that encompasses crude products, chemical feedstocks, as well as LNG. I'm sure it's going to be part of the answer.
Thank you. And if we try to stay on China a little bit, which is obviously where the biggest growth has been, Stuart, you perhaps mentioned a bit on it earlier in terms of the biggest bottlenecks. If we look apart from, are there any bottlenecks for China?
In China, I think it's mainly the import terminal capacity. And there's a lot of people have said for a long time, well, why don't they take on more FSRUs? It's a sitting duck for that market. But I think a lot of the import capacity there is controlled by the three majors, and they have long-term offtake agreements with that were agreed back in 2011, 12, 13 at sort of slightly more onerous terms than they could agree today. And there's some fear, possibly amongst them, that if they open up the import terminals to FSRU players and so forth, that they could be undermined. Cheap infrastructure together with much more attractive LNG supply deals could undercut them substantially. So there hasn't been a lot of progress on the FSRU market within China. That's certainly the feedback that we've sort of been getting. So I think the import infrastructure will continue to be dominated by the three main players.
Well, on the subject of FSRUs in China, I can say that Höegh LNG has got an FSRU in China. It's the only one there at the moment. It is an asset which I think does give its customer, who's CNOOC in our case, great flexibility, because they can use it as an FSRU in the winter when they have regas demand, and they can use it to transport LNG to their other regas facilities when it's not needed up north. So it's a very flexible product for the Chinese. There are certain sort of political aspects to it, which Stuart alluded to there, that create something of a barrier to entry. There's also, and this is very much a stereotype, but they like to build things in China, and longer term they view building onshore capacity as being maybe more their thing. But that's not to say they don't appreciate FSRUs, and we'd certainly expect to see more FSRUs in the not too distant future in China, and it's very much an area of focus.
I think if you look at, we can't get around the fact that Japan is a big player in this market, and there has been talks, or many people believe that Japan has overcommitted on volumes, perhaps as much as 10-15 million tons. How do you assess the risk on pricing and the potential impact on the LNG shipping market if they were to resell these cargoes in the market?
I'm not quite sure I follow your reasoning. Japan increased their imports over the summer, so...
meaning long term, that they have committed to too much volumes going forward.
It could be. At the same time, we hear, was it Mitsui deciding to stop any development of coal plants going forward. So I think although there's been a lot of focus in Japan on the nuclear, on restarting their nuclear facilities and thereby reducing LNG imports, I think we're seeing now that as time has gone by, they've managed without their nukes, and they're back. I think well, at least I haven't heard the Japanese talking about reducing further. But of course, as you say, they are today the biggest importer. I think China will probably surpass that in the next few years. But they're a big player, and obviously it'll have an impact on our trade going forward.
Sorry, Alastair. I was just going to say it's not necessarily a bad thing, because at the end of the day it means that it's a more dynamic market for the supply of LNG, and the Japanese are out there looking to open up new markets, just as the US Gulf Coast producers are looking to open up new markets, just as Qatar's looking to place its 50 million tons per annum of incremental capacity over the next few years. And what does that mean? Well, that's an awful lot of LNG coming to market. It means that they're not just going to focus on the big markets, because there simply aren't enough of them, and they are going to be focusing on the smaller markets, say 1 million tons per annum type markets, which of course is something which from an infrastructure point of view, whether it be shipping or whether it be on the terminal side, is has to be a positive.
And on the terminal side, where do you see the most, which areas do you have the biggest expectations to going forward?
There's a few areas, and they're all slightly different. I mean, ultimately, you only need to look at the population map of the world to see that 50% of the world's population lives within that sphere sort of around China and India. And of course, that's where you have the big cities. FSRUs send out a lot of gas, and they need a lot of gas customers. So that's a big opportunity. You then see the more bespoke type projects, like are in the news in Australia at the moment. Again, Australia is a big country, not so many people, but all the gas is on the wrong side. So having an FSRU in the southeast does make sense, because to build a pipeline from the northwest shelf down to the southeast corner is like building a pipeline from the Pacific Ocean offshore Boston down to Miami. And that's why they can make sense in places where you may not expect them to. Other than that, I do think there's a big opportunity for smaller scale projects, and maybe not sort of on a standalone basis, but as a way to get some of the bigger projects across the line. Some of the bigger projects, they need more than just a power offtaker. They need maybe some break bulking, they need maybe some supply of gas to local industry, and then I think in the future they're going to need bunkering in order to comply with IMO 2020.
Thank you. And if we look at, on the LNG side, we often talk with it on relation to oil prices, which has clearly also been on the rise. And we normally have viewed rising oil prices as good for the LNG shipping market due to the link to Asian pricing. But is there a point where, the rising oil prices now being, above 80, is there a point where it becomes demand destructive relative to other energy sources?
My personal view is I worry much more about high oil prices feeding into high gas prices and that having some impact on demand. I think there are some benefits, particularly when it opens the arb between Europe and Northeast Asia. Clearly, you've got a situation at the moment where gas prices in Europe have also had a very strong run as a result of the need to supply power demand for air conditioning in a very hot summer, and B, to refill storage from last winter. And so the arb isn't all that strong at the moment, but I do worry quite a lot about the impact of high prices on the ability to secure new demand for the future. I suppose the only tangential benefit is high oil prices feeding through into high gas prices does mean that the economics for new projects work better, and the majors and other developers of new LNG projects have incremental capital that they can put to work. So I suppose there's a marginal benefit, but I worry more about the long-term impact on demand.
Just to add to that, I think that long-term the US will probably set the level for LNG prices at somewhere between $7 and $8 per MMBTU, just simply because that's what they can deliver an ex-ship at. With Wave 2 coming along, it looks like the US will continue to dominate. New LNG. LNG prices, even though they have risen with oil, have also decoupled from oil. And I think, as you mentioned earlier, Alastair, the environmental card is more important than it ever has been, and price isn't the only thing. So I think the desire to clean up the environment is far more important than it ever has been. So I don't think necessarily these high LNG prices will be around forever if Wave 2 in the US happens, as people are saying it will. And if the LNG price comes down a bit, well, that wouldn't necessarily be a bad thing. There's very price-sensitive markets like India that could step in and stop LNG prices going too low. But somewhere between $7 and $8 per MMBTU is my sort of forecast of where long-term LNG prices should be, which is very, very competitive from an economic point of view, and obviously great from the environmental point of view.
And it's very real. I mean, that's if we were to pick up the phone to certain individuals now who have got projects in the US Gulf Coast and express a willingness to sign up a long-term contract, we'd get that price.
Obviously, you seem quite positive on the demand side of the equation. I think, speaking to some investors, some people are concerned and drawing the analogy to what happened on the LPG side, where when the US started exporting, you had a collapse of the product differentials, and you basically had no arbitrage to trade on for a prolonged time, and you had a lot of cargo cancellations. Is that something investors should be concerned of on the LNG side?
Right now, the biggest problem is the European gas prices are so high, as Alastair mentioned. So, in a normal market with $12 per million BTU in Asia, you would see a lot of reloads from Europe to Far East. So, once that window opens again, and it's opening and closing, depending on the day here. But once that opens again, you will see more re-export out of Europe. It's going to drag ton mileage, and I think that will be one of the plays here for the winter, which is going to be positive for LNG shipping. In terms of US volumes, if you look at the forward curve for natural gas on NYMEX, the curve is totally flat, so it's like 290 for Henry Hub, and it's flat the next 5 years, so you can kind of lock in cheap gas prices for a very long period of time. And then if you have this 290 and you're adding on $2.50, $3 for liquefaction, you have this $6 give or take FOB US. And if you can get gas at $6 FOB, there's going to be buyers. This is if you take $80. And you take the theoretical burn value of gas, you get to a gas price of $13, $14. So it's very attractive to buy gas rather than oil and use this as a fuel. And then you don't have all these problems with the SOx and the NOx and the particle matters. So I don't think the analogy of LPG is similar to LNG, to be honest.
I also think it's actually quite interesting when you look at the US, which has recently, over the last 2 years, started exporting LNG to today, I guess, the tune of about 25 million tons per annum, hasn't made a dent in Henry Hub. There's another 50 odd million tons export capacity coming on stream, and as you say, the forward curve is flat. Just shows how much gas there is in the US.
And that's despite historically low storage capacity of gas in the US. Despite very low inventory of gas prices doesn't move because it's endless of capacity, and it's not only that Henry Hub is the only price for gas. So places where, Permian, where you have a lot of associated gas is basically for free. So then if you have gas for free and you add some liquefaction, it's going to be very competitive.
I think we may have to move over to the supply side a bit. I see time is running quickly here. Going into the year, we were in Korea, met with all the Korean yards who all told us that we were going to see between 35 and 50 LNGC orders this year. We didn't believe them at the time, but I think now we've seen, I think at least 35. Are you surprised of the numbers, Alastair?
Yes, I think we are partly surprised by the number of orders. They all came in a bit of a rush at the in the start of the year, but I think it didn't surprise us in the sense that we think all these ships and more will be needed. So we definitely don't think that the market is over-ordered or will be overbuilt as we look forward to the macro fundamentals for demand and supply of LNG over the next 3, 4, 5 years. So I think we're not concerned about that. I think that we've been a little bit surprised by the number of speculative orders, and we've been a little bit surprised by some of the new entrants. And about 2 weeks ago, 3 weeks ago, we had the first private equity new entrant into the business. The experience of private equity in shipping in general, with LNG shipping in particular, has been absolutely horrible so far. So I wish these guys all the luck. I do think it's a very different thing ordering a ship from being able to operate it and manage it and charter it, especially with strong credit-worthy charterers. I think it is going to be interesting to see whether all the people who've ordered speculative ships, whether they can find homes for them and with whom.
What about the near term? Do you think we're going to see, as I mentioned, they expected 35 to 50. Some of them were quite certain of 50. Do you think we're going to see a lot of speculative new buildings coming in this year? And if any, who will order them?
It depends on the market. If the market is strong and there's a lot of stupid money around. People's going to order vessels.
I think the other dynamic which has definitely been playing a part here is yard prices and options. And we're coming out of a period now where yard prices have been at cyclical lows over the last year and a half. A number of people, actually including GasLog, ordered ships in 2017 and early 2018 and had priced options along with those ships, and we've exercised a couple of those options in terms of the 2 open ships that we have today, one of which is delivering in 2019 and 2020. I think most of that phenomenon has worked through the system now, and yard prices are certainly starting to tick up, and so I think that will hopefully have some impact on how the order book evolves from here.
But clearly, some of the options that has been exercised has been at very low prices, at least compared to what our brokers quote. How many of these options do you think are left for at the big Korean yards? Anyone want to guess?
Very few.
Very few, I think. Yeah. Of those options, of those sort of late 2017, early 2018 options, I think very few.
And what do you think the reason is that we've seen a big rally in newbuilding prices for tankers? Big movements on the dry bulk side and also on the container side. LNG has been pretty much flat.
It's up. If you started the year, you were maybe 180 and 182.5. Now you're more 187.5. So of course, but it's a lagging indicator, because as Alastair said, there's these option arrangements. So usually, if people order a vessel, they get the option, and it has a certain validity. Let's say 6 months. So the broker quotes are a bit lagging in terms of what is happening on the ground, and so when you see people ordering vessels, the price they are getting is maybe not what they would get today, but what is happening then when they order that vessel, they might not get 6 months validity any longer, because the yards are not willing to extend that. So I think there are fundamental drivers driving up the new buildings prices, and wouldn't be surprised if it goes to $200 million. If you look at the steel plates and everything, it's and also the slot availability. That's where the kind of the new building prices are heading.
Do you think the yards are making money at current prices?
Yeah, they have a bit strange accounting.
Or something.
Well, they have a bit different type of accounting than we do, so it's very hard to know whether they're making money or not. At least they are securing employment.
I think there's huge pressure on the yards from the government and the banks not to enter into loss-making contracts.
And in terms of, I wanted to talk a bit about the different types of new builds. The market still seem a bit divided on whether to opt for XDFs or MEGIs. Then you've gone for both.
I don't think it's divided. It's you're picking different technology have different features. So of course the good thing and the issue with the MEG is the fact that you're having a 300 bar pressure in the engine room. Of course you get a very clean combustion. You don't have the methane slip, and you have a very good fuel economy. But XDF, have this low cappuccino pressure, 12 to 15 bar, which is more easy to handle in an engine room. You have less OPEX, so it's what do you want? Do you want to have the lowest consumption and less methane slip, or do you want to have an easier operation and less maintenance cost? So I think it makes sense to have both systems. So that's why we opted, initially we opted only for MEGIs, and then we have added some MEGIs, now some XDFs, and I think it makes sense to have both technologies because there are pros and cons for both systems, and it also is very good to not having just one engine manufacturing, because then the yard prices are definitely going to pick up.
Which one?
So you've spent quite a bit of capital on installing the reliq plants on your vessels. On some of your vessels, could you talk about the rationale behind that decision? And
yeah. So we have the reliq facilities on 3 vessels now, and obviously the objective is to reduce the boil-off rate on the vessels. We put those facilities on 3 vessels which had slightly higher boil-off rates of 0.15%, and which brings the boil-off ratio down to levels which are much more competitive with newer ships. Obviously, it doesn't reduce the fuel consumption in the engines. These are all on TFDEs. But it does give the charterer significantly greater trading flexibility in terms of the speeds at which they can sell the ships, and it also can result in them being able to sell more cargo at the end of the voyage. So we think there are meaningful economic benefits for charterers, especially on the ships which have slightly higher boil-off ratios.
Is it something anyone else in the panel has considered?
Of course, we have partial relic system on 4 of the vessels in our fleet. All the Megis, they have a partial relic system. This brings down the boil-off to 0.075, which is about half of a lot of the tri-fuels and even less than half than the old steam vessels. So at 0.075, you basically have a cut-off speed of around 17 knots, which is a nice speed to have on this vessel. So it's really not a compromise. You could of course put on full relic and get the boil-off down to let's say 0.04, but you wouldn't run the vessel on that kind of speed anyway. So it's more the feature of having that is in case you do a long-term charter and you have idle time, you can avoid having to burn all the excess boil-off in the GCU. And then also in relation to storage, it would be an advantage. And sometimes if you are, let's say 17 knots is not the right speed, you are hitting a discharge port and you have some extra time, then you can put on the partial relic and go down to, let's say, 40 knots. But 17 knots on a partial relic, it's fairly ideal. So a full relic system, I think you only get the value out if you're doing longer term contracts, because you won't really get a value out of it on a spot voyage.
Thank you. And there's been a lot of talk about the economics between the MEGIs, the XDFs, and also and then the TFDEs. Now I was speaking to an owner who is not in the panel today, who actually believed that the TFDEs would be outperforming the MEGIs and XDFs in a good market. And Jon, you did a very good fixture earlier this year, which was at least higher than at the time what a lot of the modern vessels had been fixed at. Do you think that's possible, that these type of vessels will be performing better, and that the MEGIs and XDFs will be picked up first for longer term charters?
Well, obviously we've seen that the larger, particularly vessels which predominantly are MEGIs, have been fixed off early in a rising market, which probably to a certain extent gave the rest of us some time to regroup and rethink and basically hold back. It doesn't. Obviously, from a purely financial point of view, yes, big MEGIs are going to be better than smaller tri-fuels, as they are much better than the even smaller steamships. But in actual fact, we are actually now trading in a spot market, a lot of ships, and of course then it's not just a matter of your theoretical financial or economic benefit, but it's also about being in the right place at the right time and having a ship available when the clients need a ship. So there's I don't think it's in general, you ask me, would you rather have a 173,000 cubic meter MEGI? Probably. We still have, I guess, the highest rate done on a ship this year. So, yeah.
I think the other thing to bear in mind is that the MEGIs and the XDFs, I think by number of ships, are somewhere around 15% of the fleet. By capacity, I think it's nearer 20% of the global fleet, round numbers, as that's a relatively small proportion of the total fleet today. And if all of the global fleet is required because of demand, then that will tend to lead into what we're seeing today, which is there's minimal observable differentials between a TFDE and a MEGI XDF. Thank
you. And before we dig into FSRUs, I'm guessing the audience has heard plenty of the IMO 2020 today.
And that's the good thing with LNG. You don't have to talk about these damn scrubbers all the time.
Right. Opportunity rather than threat.
Yeah. That was actually my question. What kind of opportunities does this provide to the LNG industry?
I think if you took all of the existing shipping fleet and converted them to LNG, it would be about between 55 and 60% of the current market for LNG. So it's potentially massive. Obviously, that's not going to happen initially. But I think for new builds, I think for existing vessels, scrubbers will probably be the preferred option. But for new builds, cruise ships, container ships, and so forth, we're already starting to see a lot of them are using LNG for propulsion. And I think we're going to see a lot more of that. So IMO is going to be very helpful. We're going to see more small-scale ventures to support that. Break bulk LNG from FSRUs for LNG bunkering for shipping. That infrastructure needs to develop, and I think we'll see that. But no, this is a material contributor to demand for LNG, and certainly helps deal with any situation that may be the case if Japan's taken on too much LNG and has puts 3% of the global LNG market back into the market. Well, shipping could easily absorb that and some. So IMO is fantastic for LNG.
I think actually it's just to put some numbers on it. If you order at a VLCC today, you're paying $3 million for a scrubber. You could do a dual fuel LNG vessel instead for about 14. So either you do a scrubber, which is going to last you for 3 years, 5 years. I think Dag said that was his estimation, and I believe that. Or you can build an LNG carrier, put $11 million on instead, or an additional $11 million, which is all it be. It's 10% of the order, and you have a ship which is ready for IMO 2050 almost.
And we need to finish off talking a bit about the FSRU market, and at least we thought it was probably the most interesting shipping segment back in 2016. That wasn't correct, obviously. And it now seems that the projects are taking a bit longer than expected. They're not really matching with the new build deliveries, and also vessels coming off contract. Do you feel like FSRU market is turning into the FPSO market?
No. The FSRU market has seen a period of sort of slow demand, and it's a very small market. So, when you get a couple of years of only 3 projects a year, and people have been building assuming there's going to be 4 or 5, then you end up with a couple of extra vessels each year, and of course. That means that you have slack in the system, which is where we are today, and that slack needs to be wound back in. But the demand for FSRUs is still out there. It does, as I mentioned earlier, require relatively large projects, and it will be helped enormously by smaller sort of incremental demand, which can be tagged on to existing assets. And that's why we are excited about these small-scale and IMO 2020 type opportunities. But that's not to say the opportunity has gone away. It is still there. The cost of oil is going up. It could make people more keen to lock in attractive gas prices. The differential is high, and that's on the sort of power gen side. If you're looking on the sort of more transportation side, there's a big margin between where diesel trades in MMBTU terms, and which is about $16 or $17, and where you can buy LNG today. And that is certainly more than enough to capture or to be worth going after as an opportunity.
And Stuart and Richard, in terms of how you view the counterparty risk, now obviously there's been some incidents on the contract side. How do you consider that now? Are you evaluating that differently now than you used to?
I think it's fair to say we've both been burnt in Ghana. We'll put that behind us. By their nature, they've always been projects that have been developed in sort of non-OECD countries predominantly, so that's always a risk you've had to take on. Luckily, new build FSRUs can trade just as effectively as a ship, so they're not useless. And right now, even though there are too many FSRUs, you can put them straight into the shipping market and they'll earn a pretty respectable or relatively respectable return. I think, as Richard said earlier too, that you need to start thinking about a little bit of vertical integration. So we see FSRUs now more as a strategic asset that can be used to exploit other areas of untapped demand. So as Richard said earlier, and we have a classic case of exactly that in Sergipe, we have a new build FSRU that's going to start operations next year. It'll service the, I think, 14th largest gas-fired power station in South America, a project that we're developing, 1.5 gigawatts, and that will only utilise 35% of the capacity of that FSRU. So that leaves 65% of that capacity to utilise elsewhere. So for small-scale bunkering, perhaps, break bulk, taking it on barges up rivers to service smaller inland markets that are completely off-grid but could benefit hugely from a switch to gas. We could get LNG up to them for sort of $13, $14 per MMBTU, and they're currently paying the equivalent of $30 per MMBTU. So if you see these FSRUs as a strategic asset, if you can use them to create new markets, to support the original sponsor to get that project over the line, and you're prepared to get more involved in the infrastructure side of things, then there are certainly projects out there to take.
Yeah, I think we see it exactly the same way. And the key thing is to get involved with the projects early, and don't just be a supplier to a tender. Being a supplier to a tender is all well and good if you've got a really rock-solid counterparty and they're running a robust process around it. But if it's a project which is maybe more marginal, maybe it's supplying a market which is yet to be fully developed, then you really need to have good visibility on what you're getting into, and whether that means partnerships or exactly how you get that visibility will depend. But I think it is key to these more early stage projects and new gas markets, new LNG markets.
Thank you. And just the final question, I think it's one that we get asked a lot by investors, that's to you, Oystein. In terms of Flex, the Fredrickson Group, when they do things, they either go home or they go big. So I'm curious to hear, what is your vision and what is the group's vision for Flex? Like how big do you want to get? What's the ultimate size?
It's, we're not chasing size just because of size, but when we do stuff we believe in. We are simple people. We have a simple strategy. We buy the vessels when the yard prices are low, and we charter them out when the charter rates are high. And of course, there has been plenty of opportunities to build first-class assets now. The new 5th generation vessels, which our fleet consists of entirely, and there's no secret that our principal shareholder have. Before summer, ordered 7 vessels because we are bullish on the market. And, there are some benefits of scale in terms of having a fleet size, which is ideal for the physical market, to have vessels in the different basins at all time, and you can service, let's say, a contract of affreightment contract structure instead of having just TCs. And then so you are creating your own pool, and then you also have the other side of the business, which is the finance business. And of course we are now, let's say, $650 million give or take on market cap, and that's not really a big size when our shareholder is owning 52%. So of course growing the company to $1 billion is of course the short-term goal. And then of course we're going to do more after that, but we're not going to do stupid things. So of course we're only going to buy vessels when we think they are cheap, and we're going to charter them out long term when we think the rates are high. And that's the basic philosophy, and that's how we've been building shipping companies in our group for the last 50 years or so.
Thank you. I think that's our time up. Thank you very much.